Oh no, definitely, Mark. And I hear quite often family members or best childhood friends, and uh, we don't need the documents. It's a handshake deal. We're best friends, or it's my brother or my mother. Those are definitely the ones to get in writing. I see. And if you begin and you're successful, if you grow and you don't have things buttoned up on the paperwork side, I don't care if it's a $20,000 deal or a $10 million deal. It's the fastest way for families to break up and really have that family divorce. I've
Yeah.
seen it, and the more money involved, and I mean, let's just say Mark and I are best friends for 25 years. Next thing you know, we do a handshake. We're both going to flip a house, and he's not there enough on a Saturday, and we're fighting over these stupid things. Or um, I, I've seen it all. I mean, or he never intended to do the work, and I'm mad because I'm doing. I've seen it. Try to get as much as you can laid out, especially if you're doing it with friends. Uh, you have better luck having a partnership with a total stranger that you get in writing than you do with friends and family.
Yeah. All the RIA meetings over a plus 30 some odd years, people come in and you hear the story over and over. I rented to my son or my family member and they never paid, and it's heartache. And I can tell you from my own personal experience, I've done it and they didn't pay. It was so it's, I don't recommend that one. So ask questions, guys. You can ask anything if you want, even if
Hey,
it's not.
Frank, it's
Yes.
Maureen. A quick question. So we have some new investors here that are on this call. And let's say they've got their first potential deal that they're looking at, and they're going to fund the purchase. Would you recommend that they set their LLC, get their bank account, and put their personal money in their bank account so that they can show a transaction trail of that being a loan basically to their company, and then outlaying the money? Or how would you structure that to begin with?
Okay, so I mean, give me a dollar amount on a house or something, or what they're gonna do, like set it up with
Okay, so
a
for
couple.
example, let's say they've got their first wholesale deal, and it's going to cost them, $25,000. So they're going to pull $25,000 out of their personal account in order to purchase this property. Now, would you recommend that they take that 25,000 out of their personal account, show that going into their LLC bank account as basically a loan from you personally to the LLC, and then outlaying the money for the purchase? Or would you just say, no, you can go ahead, take that out of your personal account because there's still a paper trail?
I would say I would set up an LLC. I would put the money into my LLC, and then my LLC would purchase the property. It would really be not necessarily a loan, just contributed capital. If it was something that, let's say, Maureen and I were both going to do, and she put the money in and not me, she could contribute the capital and I don't, or she could loan it to our company. And the reason I say that is because if her and I formed a company with $50, she might put the 25,000 into it, and we decide we're going to pay her X% interest. But if it's me and my LLC by itself, loan or contributed capital doesn't necessarily matter. But me as if it was my investment, or me as your CPA, or me as the IRS, I would want to see you put it from your personal into your business. Now you're behaving like a business and evidencing that you do have a business, and then you buy your property. Then on top of it, now I can justify that you're evidencing your business, your cell phone. How did I get Maureen to be, or how did I get the property to be able to buy? I probably had some marketing costs. I would say I would have probably put in $1,000 last month in there to pay my marketing costs out of my business account and or my business credit card. And right now, some banks are a little bit pricey on business accounts, so I've had people avoid setting them up. Some banks have certain minimums. Definitely look around. I did on I get nothing out of it, just passing it on. I did hear recently, I think Flagstar has no cost business bank accounts, or they're real cheap or something. And just passing that on. Flagstar here in Michigan, for those of you that aren't. But I would say put the money into your LLC and fund it that way. In practice, if Maureen calls me tomorrow and has a house that I'm going to buy from her tomorrow, I may not be able to transfer it from my personal to my business account and over. I'm guilty of it myself. I've done it, but I would say it's better to have the paper trail, transfer it to your business account, and then pay it out of your business account is what I would always advise.
Can I ask a question?
Yes.
I wonder that I haven't filed my LLC yet, but I'm planning to do it before the year end. So if I file the LLCs at the very end part of the years, can I have a real estate, investment? Can this status be covered the whole year?
For real estate professional or
I think I'm confused here. Okay, maybe I should ask this question. So for my investment, the property investment lost, can that be offset the 1099 income if I still have W-2 income too? I know that cannot be offset the W-2, but can that the loss from the real estate investment offset the 1099?
If it 1099 from like real estate sales, and you're speaking
No,
of,
from real estate realtors, like the commissions of the realtor.
okay, and then the losses are from your rentals.
That's right. Yes.
Okay,
Wants to know, sets it up. Can it be like retroactive, Frank? So let's say she files her LLC now. It's still in the same year. Can that cover those types of, real estate expenses and incomes so that she gets tax break?
technically no, but within your tax return, I would probably just code it under that LLC. But the 1099 from real estate sales is going to fall under ordinary income on your Schedule C. Your rental activity is going to be on Schedule E, which is going to be a passive activity. So it can offset unless you run into the limitations that previously mentioned. You're limited to 25,000 of losses if you make under 100,000, or zero over 150, and it's phased out in between those two ranges. So, but in that situation, those real estate losses could also offset W-2 income if you're not in those limitations. So, but W-2 and 1099 all gets added together. But that's where with your 1099 real estate sales, I would say you really also have expenses. You probably have advertising, cell phone, mileage, some office expenses, maybe computer expenses, professional dues, all those things that you've paid to be a realtor. Any advertising you've done, anything else I'm not thinking of, that would reduce your 1099 income first. So that would give you then what's called your net profit from real estate sales. And then that would get added with your W-2 and then used to calculate what your real estate limitation is.
Okay, thank you.
Okay. Okay, one question, tax advantages of doing a 1031 in Michigan versus California, then tax rates more favorable in Michigan, since this, so, so with real estate, if it's Michigan property, it's going to fall under Michigan rates or Michigan laws. If it's California property, it's going to fall under California. If the question is a California LLC owning Michigan property, versus or a Michigan, um, Michigan and California are a little bit different. I'm assuming that it's more at the LLC level. Um, but if I California, the state itself is a much higher tax heavy state than Michigan. So those are different. But if we're talking a $200,000 property in Michigan versus a $200,000 property in California, most likely you're going to pay more in California. 1031 exchange now, though, under current law, and there's been some speculation whether to get rid of it, a 1031 is going to effectively defer the tax wherever you are at. So if I have a property in Ohio, Michigan, or California, and I do a correct 1031 exchange, I will defer it at the federal level and also the state level. The only state that I know of that ignores the 1031 rules are the state of Pennsylvania. But otherwise, you won't pay anything and you can defer it. Now, the other part of the question is, since tax rates will change, when's the earliest they could be? Tax rates are more favorable in Michigan as opposed to California. California and New York are specifically some of the highest tax states in the US, but tax rates, the earliest could become effective, I think might be asking when rates change. As far as a 1031 on an investment property, you can keep doing that, as you could roll a single family house into a bigger single family house into a bigger multifamily, and then swap it for an office building and effectively never pay tax on that if you're doing a 1031 exchange. There has been talk about eliminating that. I'm not sure how the recapture of everything would work on that, but definitely a 1031 exchange is the better way to go if you can defer it. Right now, we do have very low capital gains rates, and honestly, I have some clients that are continuing to do 1031 deals right now, and some that actually opted not to because they were unsure of future tax rates. So, based on current rules, I would always say do a 1031, but understand that's where at a future date, when you're refinancing the property in 20 years from now, and you've 1031'd it multiple times and cashed out refi, you could sell it, walk away with very minimal cash, and have a very large taxable gain. And if you don't hold it till the day you die. So at least just understanding the road you're walking down, I always advise somebody to understand how a 1031 impacts a future sale, especially when you're using leverage. And then another note on 1031 exchanges, I get that question a lot. If you're looking to sell a property on a 1031 exchange, make sure to have everything in place before you sell the property. At closing, the title company will take possession of the money and what's called the qualified intermediary. And then you have 45 days to identify your new property and 180 days to close. If I go to closing, I walk away with a check and I plan to buy a property, the second that I've touched that check or had it made out to me, I cancel any opportunity to do a 1031 exchange. So don't call me tomorrow. Tell me yesterday you sold the property and you're looking to do a 1031. Everything has to be in place before you do the transaction. And it's just something to be aware of. And usually I wouldn't say call the week of closing. There are companies that handle much larger commercial properties, and then there's companies that handle smaller single family properties. And when you do a 1031, it's based off of the selling price of the property. So if I'm selling a house for $100,000 that has an $80,000 mortgage, I'm only getting 20,000. I have to find replacement property of 100,000, not the 20, not the proceeds that I'm getting at closing. I've heard some confusion over that before. So so if it's a leveraged property, you're going to be looking at buying a larger leveraged property in the future. Any other questions? You can also send them direct if someone doesn't want to send them on the group chat there.
Yeah, there's no stupid question. Probably if you've got one, there's probably a bunch of other people have got it too.
I say ask. We've all been there, and anything else, Mark or Maureen, or
Nothing I can think of. If there's one. Brian?
Well, okay. Yeah. Hi, Frank.
hello.
So I am just trying to get some clarification on, I'm told that right now on a commercial property, if you upgrade the HVAC, that we're going to get to write that all off this year. Have you heard anything about that?
Yes, for the accelerated bonus depreciation. Is that what you're referring to?
I think so.
Okay.
Is that what it's called? And is that only going to be limited to commercial properties, or is that something like a rental unit, that like a duplex or a 12 unit where I would be able to take advantage of something like that?
So the accelerated depreciation, and when you get into the commercial realm, the numbers are bigger, but and that's didn't really talk about that too much, but the bonus depreciation and accelerated depreciation are, I mean, let's say we have $1 million building or $800,000 building, and we put $200,000 into repairs on that. The 200,000 may be a lot of equipment, HVAC, a lot of items that qualify for bonus depreciation. And we did all that, let's say this year. We might have invested $1 million on there. 800 of that might be attributable to the building, and maybe less. Then the rest of the identified improvements, such as the HVAC, those generally would qualify for potentially for accelerated depreciation. So that's where really with real estate that's being improved, you're going to generate your monthly cash flow, rental income, less your ordinary operating expenses. But when you build out that property, that let's say 200,000, you might qualify for a $200,000 depreciation deduction on that and effectively end up with negative taxable income. That occurs frequently on my larger multifamily clients that have multifamily properties that they'll purchase, put a substantial amount of renovation. If you think at the unit level, they're doing appliances, painting, carpeting, build outs, different repairs. A lot of that type of improvement qualifies for accelerated depreciation. So it can actually generate large tax losses. And then it becomes into question, if you're not a real estate professional, you may run into the limitations that we discussed earlier. So somebody that has a W-2 job, if you give them $200,000 of tax losses, they may not qualify to get the benefit. They won't lose them. They just get carried over into the future. So you can, then it kind of circles into another question I get a lot, and I hear talked about cost segregation studies. So for instance, on a $1 million multifamily property, let's say that you have a property for multifamily, a cost segregation is going to go in and identify what of that is appliances, HVAC equipment, so that I can take those accelerated depreciation. You generally would have those done when you're not having a substantial amount of renovation, but that's where the large depreciation deduction comes on the front end. So generally, Brian, yes, you would qualify to be able to deduct that. How that's going to benefit you would matter if you have a W-2 job and what your other limitations are. So I bring that up. A lot of investment deals have, let's say, 4 doctors in them that have large W-2s. Generally, they're not going to qualify. So for them, they're not as going to benefit, but a real estate investor generally would benefit from that. They would be able to offset other income that they have.
Okay, and so it isn't just HVAC, are there more, is it just any improvements that we do this year that are going to be able to be accelerated?
I mean, there's going to be certain improvements. I mean, if you're doing land improvements or I mean, there's certain improvements that don't qualify, but generally a lot of the improvements will qualify. I mean, without knowing all the details, but yeah, there is bonus depreciation and there is accelerations that you can take on that. The one issue though, if you take it today and then let's say you sell it a year from now, you're lowering your basis in that investment for the depreciation you are taking. So that's where, if you, let's say it's $1 million property and you had the 800 for the building and the 200 for improvements, I take the $200 deduction today, then I sell it next year for 1.1 million. I'll actually have a $300,000 gain because I took a $200,000 deduction this year. So so my 300 gain is my 200 depreciation recapture plus the true 100 gain.
Okay,
So I mean, depending on what it is and what the benefit is, that's why so I do opt out of bonus depreciation with certain clients after I discuss it with them, because if they're not going to get the benefit and they plan to sell it, it might make sense in their situation not to take it and have the carry forward suspended losses. I'd rather just not have the losses and have a smaller gain in the future. Okay. Did that answer your question, Brian?
yes,
Okay.
thank you.
Okay.
Hey, Frank, Maureen again.
Yes.
Zeus. Since we have a few real estate professionals on here and maybe some homeowners themselves, I just wanted to ask you, have you heard about the potential of extending the first time home buyer credit or the home buyer credit upgrade like they used to offer, where it was what, $7,000, I think, that they were offering as a credit for a principal residence? Have you heard about them possibly extending that?
Or reenacting them, you mean?
Yes, exactly, yes.
I did hear that one administration it is out there, but uh, I saw it in some of the tax proposals, and I want to say I saw it up to about 15,000. But it really depends on, I think, as far as from a home buyer.